Hello investors and future investors, welcome to the channel. In this video, we will be going over an option strategy that will allow you to own stock at a discounted price and also allow you to make weekly revenue using your discounted shares. If you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. Welcome to Investment Gains. Let's jump right into it. Our strategy for today will be the PMCC, or Poor Man's Covered Call. But what is the PMCC? The PMCC is an option strategy that allows you to sell covered call against another call option in your brokerage account. This other call is known as a LEAPS, and it allows you to leverage the use of 100 shares, although you do not own it outright. If you're not familiar with LEAPS, then I advise you check out my video on LEAPS. I'll link it above. Word of caution, you need to choose good strike prices so that you're not assigned the shares. For help with selling weekly calls using LEAPS, check out my Patreon. I'll leave the link in the description. If you are assigned while selling covered calls, it's not a big deal. Just keep watching. So, step 1 using the PMCC is buying an in-the-money option, usually 6 months or more, with a delta of 80 or higher, aka a LEAPS option. For today's video, we're going to be using ChargePoint. Since I already own a LEAPS on ChargePoint, as you can see here, the expiration date is January 21st, 2022. So step 1, buy an in-the-money call. Step 2, sell covered call against your LEAPS to generate weekly income. Now that I do own this LEAP, what we're going to do now, I'm going to show you how to sell covered call to receive revenue. So let's jump into ChargePoint real fast. Okay, so this here is ChargePoint. This is actually the LEAP that I do own. So as you can see here, the expiration is January 21st, 2022. My cost was $1,125, and as of today, I'm currently up $215. So right there is the power of LEAPS. So what we're going to go ahead and do now is sell a covered call. So we go to view all options. We're going to switch this over to sell and call, and we're going to choose the expiration date. Today is 4/26, so we're going to choose 1 week out, which is going to be May 7th. So now we're here on the options chain. I'm going to choose my strike price. Now, if you're familiar with this channel, you know that I like buying and selling calls at an 80% chance of winning. So we're going to use the 29.5 right here. And for selling this call, I'm going to receive 0.73 or $73 into my Robinhood account. So I hit continue. I choose the amount of contracts I want, which is going to be 1. I hit review order. And as you can see, once I hit submit, I'm going to receive $73 into my account. And that money is mine right away to do whatever I want with. I could withdraw it to my bank account. I could go buy lunch. That money is mine right away. So this is the leverage power of doing the PMCC, or Poor Man's Covered Call. So the first way to win with a LEAPS is actually holding it in your account as the share price escalates. So as you can see, just holding this in my account, the share price goes up and I just keep making money. The second way you win is by going ahead and sell covered calls for weekly revenue, which gives you more money. Those are the two best ways to win with LEAPS. So what are the benefits of LEAPS? The benefits of LEAPS is that 1, you get a share price increase and you keep growing your account by selling covered calls. In order for you to benefit from this strategy, you really need to make sure that you choose a good strike price for your LEAPS. Now that we own a LEAPS, we went ahead and sell a covered call, and for that we received $73. So what's going to happen at expiration date? So a couple of things could happen. The first scenario is that at expiration date on May 7th, if your share price is below your strike price of $29.50, then that's good. You get to keep your LEAPS, you get to keep your premium, and you get to do this strategy again the following week. So what happens for the reverse now? If at expiration date, if ChargePoint is trading at a price higher than your actual strike price, then you may be assigned the shares. However, there's a couple ways that you could manage this. Your first option, you can just roll over the call. Now, in order to keep this video very simple, I will not go too much into rolling out calls. Another option you have is to let this expire. So what happens when this expires? So at expiration date on April 7th, if your share price is now above your strike price, then what Robinhood does is that Robinhood is going to go and they're going to buy your sell call. Your leaps remain intact. So now we're going to do an example using American Airlines. So first, we go to trade, we go to buy and call. And remember, we choose an expiration date, which is 6 months out or more. So we're going to use the January 21st, 2022. Now we need to choose our strike price, which is below the actual share price. Let's go ahead and use 15 as a strike price. Now, as you can see here, 15 does have a delta of 0.84 or more. So this one should be perfect. So we're going to go ahead. We're going to hit our premium right here. We're going to hit continue. We're going to hit the amount of contracts, which is going to be 1. We're going to hit review. And as you can see, in order for me to purchase this leaps option on American Airlines, I will have to pay $820. If I were to buy 100 shares of American Airlines, it would cost me $2,200. So as you can see, this is one of the benefits. Now that we own American Airlines, we own a leaps that expires January 2022. Now we turn that around and then we go sell covered calls. So again, we go to options, we go to sell, we choose our expiration date. Let's use May 7th for this example. We choose our strike price higher than the current share price. So we hit our premium, which is going to be 0.21. We hit continue. We choose the amount of contracts we want to sell, which is going to be 1 because we only own 1 leaps. We hit review and we're going to receive $21. So once you get accustomed to this strategy, you will be buying and selling calls on stocks that you thought you could not afford before. Just a heads up, not all brokers allow this strategy as they don't recognize leaps as owning 100 shares. So your leaps can be used as collateral for selling covered calls. Now, we have lots of strategies like this on this channel. So if you want to support the channel, like and subscribe and hit the notification bell to get an alert whenever I post a video. Also, share this video with someone you think may benefit from this strategy. Thanks for watching, and remember, you never lose when taking your investment gains.